Bhargav, markets have hit all-time high just a few days back, and now people are talking about 3x, 4x in next 10 years for Nifty, for Sensex, for mid cap, small cap, despite of all the indices almost on their highs. What do you think has changed this time? Why the investors are not nervous? Every time earlier people used to be nervous, now we are seeing significant inflows, 10,000 crores, 10,000 crores of SIP inflow nearly on a month. Last month it was 9,960 odd crores. So are we looking for a decadal bull run? Can it happen? It has never happened in the past. Can it happen? And why?
It's been almost 8 years of positive returns for the markets. And as you mentioned, there is some element of fear what will happen in the ninth year. But let me take back you to US during 1980s. So if you look at 1987 to 2000, that was a period when US actually went through a significant secular bull market. And if you look at the underlying drivers of that, what you notice is that the mutual fund AUM as a percentage of US GDP actually increased from about 10.9% in 87 to 70%
Wow.
in 2000. So there was a significant penetration of retail money into mutual fund, which actually helped the market to stay in that secular mode. And if you look at numbers now, it's at 125% of GDP. So when we talk to a lot of SMEs as well as HNIs, what we see in India is something very similar. So if you look at post demonetization, the usage of cash sort of in the economy has reduced significantly. And as that happens, your avenues like investing in land banks, investing in real estate, sort of also dry up. So earlier people used to say that the pre-tax and the post-tax returns in cash transactions is similar because there is no tax to be paid. But now with sort of demonetization and more digitalization, where you get caught if you do cash transactions, the pre-tax and the post-tax returns are become very different. So if you invest in a land bank or a real estate transaction, earlier if your pre-tax returns used to be 15%, the post-tax also used to be 15. But now if you pay tax, it reduces to as low as 10. So I mean, you now have to compare 10% return on a land or a real estate with a 16% return in equities. So therefore, the equities as an asset class has become that much more attractive. And if you talk about numbers and if you look at mutual fund AUM as a percentage of GDP in India, in March 20 it was just 10.9, and in just 3 years it has become 17%.
Wow.
So essentially, there is a behavioral change which has happened. Few data points to substantiate that is that as you talked about SIPs, if we sort of talk about SIPs, more than 50% of SIPs are being contributed by digital platforms like your Paytm, Grow. So clearly, more and more people who are digital savvy are entering the markets. More and more money, more than 50% is coming from tier 3, tier 4 cities.
Wow.
So that class of the people who are investing in, say, a land bank or a real estate are now coming into investing in equities. So clearly, we see that if equity as an asset class is seeing more and more success, then why not we sort of go the way US had gone during 87 to 2000. So again, the mistake which people do is sort of comparing valuations with historical averages. But if you talk about liquidity, and last year, if you look at the mutual fund, were one of the main pillars of ensuring that the equity markets perform. In fact, FIs for many months last year were net sellers. Still, I mean, the retail money helped mutual funds to sort of become buyers and support the markets. And another leg in terms of FI money, if you look at data point, Indian FI money is about $0.6 trillion dollars. And if you look at China, it's about $3.6 trillion dollars.
Wow.
So now that China is becoming more and more unattractive, if 10% of that money flows into India, then the FI money will rise by 50% in a single year. So when we talk to a few emerging market fund managers, their view is that money will come out of China and that allocation will come to India. So clearly, I mean, one should not ignore India just because it is expensive. There is a reason why it is expensive, and my personal sense is that we are in a secular bull market.
So fantastic perspective what Bhargav gave is A, India is having a macro shift in the earnings. Number two, flows are gonna be relentless here. He spoke about 10% mutual funds as a percentage of the GDP just being 10% and now it is moved to 17%. And remember, we are talking about an increasing GDP on a constant basis. So the flows are only gonna multiply from here. Financialization of savings instead of fixation of savings in the fixed assets. That's going to be history. So, guys, remember you are in for a secular bull run, and hence, if you miss out on this equity run, you will clearly be outliers remaining in the mediocre return range rather than moving into the higher return range.